Hey, ladies and gentlemen, what's going on? This is Mike Price with Network Funding, your local lending specialist. I'm also a real estate agent, which is why you see the Mike Price Hybrid Agent title on this deal. But I want to do a real quick home buyers course that is going to be something that you can preview in your house. Now, I know a lot of people out there, they hold these events to get you to come outside of the house to get some information. But I wanted to give it and make it to you, make it extremely easy for you to get this information. Now, this first section is going to be specifically about the lending side, the mortgage side, because that's the most important side of the actual mortgage process. So a little bit about myself. I've been in the mortgage business for over 15 years and in the overall real estate industry. I've actually sold homes for a builder before getting into the mortgages. So I've got a little bit of experience in this deal. Graduated from Texas A&M University in College Station. I am married with a beautiful baby girl who is spoiled rotten. My NMLS number, mortgage license, is 244007. You can look me up online to get all of my credentials and make sure that I know what I'm talking about. So the first thing I want to talk about in this home buyers course is the actual loans. Because like I said, I think that loans are the most important piece of the home buying process, unless you're going to be paying with cash. Now, at the same time, the loan is the most overlooked part of the process. Everybody wants to go out and start looking at houses immediately. But you have to have that loan in place before you go out. You don't have to have it in place, but it is definitely beneficial if you do already have that in place. So get the loan in order before you start home shopping. It's just a smarter way to do business. Everyone watching this has probably gone out and bought a car, and you find the car you find the car that you like. You got to go sit in the finance office, and you sit in that chair across from the guy while he pecks at his computer in hopes that you get approved. Well, when you have your loan in place before you go out house shopping, for one, it makes your offers way stronger. But two, you already know that you're going to be approved, and it's a better process. And getting a loan these days is way easier than 90% of the people think it is. And you'd be surprised how many people thought that it was just going to be this long, drawn out process. And I tell them, hey, just sit back, relax. Your loan's approved, basically from me looking at their information on day one. But just don't get too caught up on it. Talking about loans, excuse me. There's really four main types of loans. You have your conventional, your FHA, your VA, and your USDA. All right, so on the conventional loans are basically loans that are not insured or guaranteed by the government. Instead, it's backed by private lenders. The insurance is typically paid by you, which you'll hear the term PMI. FHA loans are just a type of loan that the Federal Housing Association backs, and they're backed by the government, for typically reserved for first-time home buyers or folks who may have a hard time being approved. Minimized credit qualifications, reduced down payment requirements. A lot of people think that FHA loans are bad loans. They're not. We're starting to see a lot of people with great credit go and do FHA loans just because of the down payment requirements, or some other requirements that would really take a lot longer to get into any and every specific situation in this deal. Now, let's talk about VA loans. VA loans are for veterans. It's issued by private lenders backed by the Department of Veteran Affairs. I mean, it helps veterans get in, active duty members, widowed military spouses. Pretty much if you know or you're related, well, I won't say related, but if you were married to someone who was a veteran, you can probably qualify for a VA loan. We'll talk about that specific scenario. But if you're a veteran, chances are you already know what this is. Now, you do have to be a veteran in order to qualify for a VA loan. Now, USDA loans, and I'm just going to read this to you verbatim. USDA loan is a mortgage loan offered to rural property owners by the United States Department of Agriculture. These are 100% financing loans. Now, you can get these. Now, you have to be in a USDA qualified area. You can't be in the heart of Dallas, Texas, or the heart of Houston and think that you're about to get a USDA loan, because they're more for suburb areas and rural areas. Okay. Now, let's talk about the four main loan components. Okay, you got your down payment, you got your closing costs, you have interest rates, and you've got the loan term. Okay, now the down payment. What the down payment is that's the amount of money that the particular loan requires you to put down. Okay, now some lenders, some down payments will be in a 5%. Some of them are some are as little as 3%. The conventional 3%, conventional loans do have a 3% down payment. Most people think that you've got to put 20% down, but that's not the case. Now with FHA, it's going to be 3.5%. But I want people to know that it's definitely not 20. Depending on the type of loan that you select is going to determine which actual loan or which actual down payment that you're going to be required to put down. Now, some loans like we just spoke of, like your USDA and your VA loans, those don't have any down payment requirements, but they have some other specific requirements that you have to have in order to qualify for those. So I have to get this message out. You do not need 20% down to buy a house. I mean, 20% is a lot of money. If we're talking 200 grand, that is $40,000. Everybody doesn't have 20% to put down on a home. And these days, the way that these prices are, nobody will be able to afford a home. So don't think that you have to go out there and have 20% in order to purchase a home. Okay, so as far as, let's talk about the closing costs. Closing costs are basically fees that both the buyer and the seller pay to various third parties on closing day to finalize a loan. Okay, see, most people don't realize that the seller has to pay closing costs as well. But yeah, if someone's selling their house, they're going to have some closing costs that they've got to pay as well. Now, some of these closing costs can be an appraisal, homeowner's insurance, property taxes, points that you may pay on the loan to get yourself a better interest rate, origination fees, title fees. There's a ton of different, I won't say a ton, but there are a lot of different fees that could be constituted as actual closing costs. Okay, now here's the main thing that most people get confused on. That the down payment and the closing costs are two separate costs. They're two totally different deals. Closing costs are going to vary from person to person, loan to loan. And the down payments are going to pretty much remain the same, whether you're doing a 3% down, 3.5% down, 5% down, or if you just want to really jump out there and put 20% down, your closing costs are going to be on top of whatever that percentage is. Okay, now let's talk about the payments, because this is probably the most important thing for anybody is, okay, what are these payments on this loan going to run me? What are my monthly payments going to be? All right, so there's a couple of components when we're talking about payments. You got your principal, your interest, and the thing that everybody likes to forget about is the taxes, okay? And the insurance. So that principal, your principal is just say the initial amount of your loan. The principal is the portion that makes your balance decrease. All right. The interest is whatever the bank is charging you. Say it's 3%, 4%, 5%, 5.5%, whatever your interest rate. So you take that principal and interest, and you get your actual payment. Now, don't forget to add your taxes and your insurance. Now, taxes is going to be your property taxes, where we're talking about the county taxes, the city taxes, where you pay for the school district and all that. Completely separate from your income taxes, but your house will have taxes on it. And of course, you've got to have insurance just in case something goes wrong with your house. Here in Dallas, we just had a bunch of tornadoes. Hopefully everyone whose home was damaged has property insurance that's going to come through and take care of all that damage. Now, when you look at this acronym, it's PITI. You'll probably hear that somewhere. That is principal, interest, taxes, and insurance. Everybody pays all of that, unless you're doing an interest-only loan, which I personally don't recommend, because you're never going to pay that house off. And we'll get to that later. You will have principal, interest, taxes, and insurance. I'm sorry. Okay. Now the next deal that we're going to talk about here is just a couple of mortgage loan terms. You're going to have a fixed rate. That's typically just your typical 30-year fixed loan. You've got an adjustable rate mortgage, which is otherwise known as an ARM. And basically what that is it's going to be fixed for a certain amount of time. Typically people get into these because on an ARM, you get a lower rate for the first couple of years or whatever that set term is. It can either be a 3-year ARM, a 5-year ARM, a 10-year ARM. And that rate is fixed for that amount of time. So if it was a 5-year ARM, that adjustable rate mortgage is going to be fixed for 5 years. Now, after that, depending on what the market is doing, it can adjust upwards. I can't guarantee you that it will go up. Chances are it is not going to go down, depending on what type of ARM loan that you're getting. Now, there are also some interest onlys, which I touched on before. An interest only, which is a loan where you're only going to be required to pay the interest on the loan. Okay. Now, since you're only paying the interest and you're not paying any principal down, your balance will remain the same until you start paying some of that principal. So if you did a 10-year interest only loan, okay, for the next 10 years, if your house was $200,000, 10 years from now, your balance is going to be $200,000. So those are great for people who are going to be purchasing in areas that have some really high appreciation, and you're not going to be living in the home for a long time, and you just need to get a cheaper payment. However, you still have to qualify for that house on principal, interest, taxes, and insurance. So you still have to be able to afford the full payment. The interest only piece is just a benefit for you to go out and make a cheaper mortgage payment. Okay, now let's talk in loans in terms of mortgage loan terms. We just kind of touched on this as well. You have your ARMs, which are adjustable rate mortgages. They're typically in 5-year and 10-year fixed periods. Your 30-year fix is the most common loan out there, most common fixed rate term. Now you can do a 30-year, you can do a 15-year, you can do a 10-year loan, you can do a 25-year loan. The interest onlys typically are 10-year interest only ARMs, which hopefully that property has appreciated. We'll look at your specific scenario to determine, hey, if that's going to be an option for you, or if that's something that you even want to see if you can be qualified for. Now, interest rates. Everybody wants to talk about interest rates. This is the main thing that consumers are worried about. And the reason for that is that's because that's what's plastered all over the news each and every day. Interest rates. It's not the only component of your loan. It's not the only piece of that loan. Do not let the interest rate scare you from buying a home. Do not, because there are situations out here where I've seen higher interest rate loans have lower payments than lower interest rate loans, because you've got some instances where a higher rate won't have mortgage insurance, or it won't have a private mortgage insurance, or it won't have a mortgage insurance premium, and those are FHA and conventional insurances. If we can find you a loan that has a higher rate but doesn't have the PMI, obviously the payment is going to be a lot lower. And remember, we just talked about that. The most important deal for 95% of my consumers is going to be the payment. Okay, now the interest rates, again, I kind of want to touch on that. Let's just make sure that the interest rate isn't going to be a deterrent. It's the payment, and I guess I kind of got ahead of myself. The payment is going to be the most important thing when you're purchasing a house. It doesn't matter if you have an interest rate of 0%. If you bought a house that was so big and it cost so much that you still can't afford to make that payment. Now, you want the best interest rates. Obviously, better credit scores get better interest rates. The more money you put down gets you a better interest rate, because now you're less risk to the bank and you've got a little bit more skin in the game. So if you go out here and you put down 20%, you put down 30%, you're less risk to the bank. Assuming, just say, for some reason you may go through a situation to where, hey, God forbid you have a foreclosure. the bank is going to look at that. If you put more money down, you're less risk to them, and they can turn around and take that house and sell it back and not lose any money because you put more down. So this, for the simple fact that you put more money down, you will be rewarded for a little bit better interest rate. Okay, now down payment assistance. Let's talk about the down payment assistance. Down payment assistance programs will give you cash for the down payment and the closing costs. They have slightly higher interest rates. There are some credit score requirements. There are some income limitations. Now, if a down payment assistance program is going to be right for you, that's something that we will discuss, and definitely make sure that you know all the ins and outs, because some of them have to be paid back, some of them don't have to be paid back. There's way too many to try to go over in this real quick crash course. But definitely, if it's a program that's for you, we'll make sure that you get it. If it's not, and it's not going to put you in the best situation, we try to keep people away from them, because, like I said, they do have a little bit slightly higher interest rates, and we want to make sure that we're not setting you up for failure by giving you this down payment. Because, I mean, at the end of the day, nothing is free. However, some of these down payment assistance programs, the money does not have to be paid back. We just have to look at the loan and look at your scenario to make sure that it's going to be in your best benefit to take that. Now, I know you've been seeing this hybrid agent deal here flash across the top here, or this posted across the top. What a hybrid agent is a hybrid agent is a loan officer and a real estate agent. Now, obviously, you can see my name is Mike Price. I am a real estate agent, and I can help you with your closing costs by simply providing my hybrid agent service. So when I do both the loan and I help you on the real estate, I help you find the house, and I'm your real estate agent, I'm willing to give you a portion of the real estate commission to go back towards your closing costs. Now, I don't know of very many agents who are out there who are doing that for you. However, I can tell you the amount of money that you would save by exercising that right of having someone who can do both the loan and both the real estate transaction. How much money you're going to save doing that is astronomical. Not to mention, you're not dealing with 2 and 3 people to help you facilitate this transaction. You're dealing with one person. That one person knows all your needs and what it is that you're looking for. And so that's definitely something that you should look into. Hey, hopefully this part of the course has helped you out. I know it probably went really, really fast. It's recorded, so I want you guys to be able to review this information. If you have any questions, if there's a comment section below here, feel free to post these in the comments. Definitely feel free to reach out to me. My direct line is 214-264-5707. I would definitely like to speak with you and see what we can do to get you helped out. But hey, hopefully this has been helpful. I look forward to speaking to you soon. Take care.